What if I told you that trying really, really hard to pick winning stocks is probably costing you money? It sounds counterintuitive, right?
It really does.
We see headlines about investors who made a killing or hear about these, brilliant fund managers. But when you actually look at the data, well, it tells a surprisingly different story.
Yeah, one of the most striking things we found pulling together the sources for this deep dive was exactly that. There's this statistic, and it comes up again and again in the research.
Which one is that?
Year after year, the vast majority, we're talking something like 80%, sometimes even higher, over longer periods of professional money managers, people who do this for a living, fail to beat a simple market benchmark.
80%, that's huge.
Yeah.
So most of the experts aren't even matching the average.
After costs, yes. It's kind of like discovering that running this incredibly complex obstacle course, designed by experts, often leads to slower times than just, being on the simple, flat track.
That's a great analogy.
And that statistic, it's pulled right from the research we looked at. It's a really powerful argument against, or at least a challenge to, traditional active management. And it gets right to the heart of index funds. Why make things complicated?
Right. Why try so hard to beat the market when just tracking the market's overall performance has historically worked out better for most people, especially, like you said, after you factor in those costs?
Exactly. And that simple, often more effective path, that's what we're diving deep into today. Index funds, specifically in the U.S. stock market.
Okay, so forget trying to find the next big thing, the next Amazon or Tesla before anyone else does.
For most investors, we're going to unpack what these index funds actually are, why they've become such a cornerstone for millions of investors.
We'll look at how they work behind the scenes, and we're going to use probably the most famous example of this whole philosophy, the Vanguard Total Stock Market Index Fund, Admiral Shares, or VTSAX, to kind of bring it all to life.
And we'll definitely touch on that popular, really laid-back strategy. People talk about VTSAX and chill.
Ah, yes. VTSAX and chill. Sounds relaxing.
It's meant to be. We've pulled together insights from, a stack of articles, some academic research, and even looked at what people are saying in online communities to give you a really comprehensive picture.
So our mission here, as always, is to cut through the noise, filter out the jargon, and give you the essential nuggets from all these sources. You'll understand the whole phenomenon, the good stuff, the potential downsides, without getting bogged down.
Yeah, so you can figure out if it makes sense for you.
Okay, let's get into it. We're going to tackle questions like, what really is an index fund compared to other investments?
Yeah.
Why are they so hyped up right now?
How does a fund actually hold, thousands of stocks? What are the real benefits, but also what are the risks you need to be aware of?
And that big one, what's the practical difference between VTSAX and its famous cousin, the ETF version, VTI? Let's unpack this simple but really powerful investment tool.
Sounds good. Let's start right at the beginning. At its most basic, what is an index fund?
Yeah, the definition.
Okay. Think of it as an investment fund. It could be a mutual fund, or it could be an exchange-traded fund, an ETF. And it has one single, very clear job: to copy as closely as possible the performance of a specific market index.
And an index is just like a list, a recipe.
Kind of like a recipe, yeah. Or a predefined list, a basket of securities. Like the S&P 500, that's an index representing 500 of the biggest U.S. companies. The fund just aims to hold those same companies.
Okay, so instead of having a star portfolio manager and like a whole team of analysts trying to figure out which stocks are going to go up or down.
Right, trying to predict the future.
An index fund strategy is way simpler. It just buys whatever stocks are on that list in the same amounts.
Precisely. That's the core idea of passive investing. It's the complete opposite of active management.
Where they're always buying and selling.
Exactly. Active managers are constantly trying to pick winners, time the market shifts, trade frequently, all in an attempt to do better than some benchmark index.
Which we already know is hard.
Very hard, consistently. Passive index funds, though, they aren't trying to be clever or outsmart anyone. They just follow a set of predetermined rules for tracking their specific index. Often, they use complex computer models to manage the holdings really efficiently, with, frankly, minimal human intervention in the day-to-day buying and selling.
That makes sense conceptually, but how does it work in reality? Especially for a really broad index. I mean, the S&P 500 is 500 companies. That's a lot.
Yeah.
But a total stock market index, that must be thousands. Does the fund really buy every single one?
That's a great question. Ideally, yes. The gold standard is called full replication. The fund aims to hold all the securities in the index and in exactly the same proportions, the same weights as the index itself.
Okay.
However, like you said, for really broad indexes, maybe ones with thousands of stocks, or indexes that include stocks that don't trade very often, what they call less liquid securities, trying to buy every single one perfectly can become incredibly difficult or maybe just too expensive to manage efficiently.
So what do they do then?
In those cases, they might use a technique called statistical sampling, or sometimes optimization.
Statistical sampling. How does that work for stocks?
Well, instead of buying absolutely every stock, the fund manager buys a representative sample. They choose a selection of stocks whose combined performance is expected to very closely mirror the performance of the overall index.
Like a poll. You don't need to ask everyone.
Exactly like a poll. They might group stocks by, say, industry sector or company size, market cap, and other factors, and then buy a representative sample from each of those groups. The goal, whether it's full replication or sampling, is always the same. Minimize what's called tracking error.
Tracking error.
Yeah.
The difference between the fund and the index.
Yep. Just the gap between how the fund actually performs and how the index it's supposed to follow performs. Good index funds have incredibly low tracking error. They stick very, very close to their benchmark.
Got it. So full replication if possible, sampling if needed. But the goal is always just stick to the index. So what are some of the big U.S. indexes people are likely to hear about that these funds track?
Well, the most famous is definitely the S&P 500. You hear it quoted all the time. It tracks 500 of the largest U.S. companies, representing maybe 80% of the total value of the U.S. stock market.
Okay.
Then there's the Dow Jones Industrial Average, but that's much narrower, only 30 large companies, so it's not really representative of the whole market in the same way.
Right. You hear about it, but it's different.
Very different. Then there's the NASDAQ Composite. That tracks over 3,000 stocks listed on the NASDAQ exchange, and it's known for having a lot of technology companies.
Make sense?
And crucially for our deep dive today, there's the CRSP US Total Market Index. This is the big one VTSAX tracks. Its goal is to capture nearly 100% of the investable US stock market. Everything from the absolute giants down to tiny little micro-cap stocks.
Wow. Nearly everything. And the fact that these funds even exist and are so popular, it kind of points back to a really fundamental idea in finance, doesn't it?
Yeah.
The idea that trying to consistently pick winners or time the market is,
Oh.
well, it's just incredibly difficult.
Absolutely. It ties directly into something called the efficient market hypothesis, or EMH.
Ah, the EMH. I've heard of that.
Yeah. In its simplest form, EMH basically suggests that all the publicly known information about a company is already reflected in its stock price. It gets incorporated so quickly and widely
That there aren't really any hidden bargains lying around.
pretty much. It makes it extremely difficult for any investor, even professionals, to consistently find stocks that are truly undervalued or to predict where prices are going well enough to reliably beat the market average over the long run, especially once you factor in the costs of doing all that research and trading.
So if the market is, let's say, reasonably efficient, or maybe just efficient enough, then trying to outsmart it all the time is often kind of a waste of effort and potentially money.
That's the argument. An index fund just sidesteps that whole challenge. It essentially says, okay, if beating the market is this hard and expensive, let's just be the market.
Let's just aim to get the market's return.
Exactly. They accept the market return, which historically has actually been pretty strong over the long term, knowing that most attempts to get higher returns through active strategies tend to fall short, especially once you deduct those higher fees active managers charge.
Which brings us neatly to the next big question. Why have these funds become so incredibly popular? It feels like they've gone from this niche academic idea to being absolutely everywhere in investing.
Yeah, they really have exploded. There are several powerful reasons, but as the sources we looked at really emphasize, the single biggest driver, it's undoubtedly their low costs.
Okay, costs. And that's something you as an investor can actually control, right?
Yeah.
Unlike where the market's going next week.
Precisely. And costs have this massive compounding effect over decades. Index funds are just inherently cheaper to run than actively managed funds. Think about the difference in operations.
Okay.
An active fund needs a big team, right? Highly paid analysts digging into company reports, researchers looking at economic trends, portfolio managers making buy and sell decisions constantly.
Lots of salaries, lots of overhead.
And they trade stocks much more frequently as their opinions change, which racks up trading costs too. A passive index fund, on the other hand, it just follows the index rules. It needs far fewer staff, way less research, and it trades much, much less often, basically only when the index itself changes, which we'll get into later.
Less activity means lower operating costs.
Simple as that. Less overhead, less trading leads directly to the lower operating costs for the fund.
And how big is this cost difference in practice? Can you give us some typical numbers?
Sure. The annual fee you pay is called the expense ratio. It's shown as a percentage of your investment. For the really broad U.S. stock market index funds, like VTSAX that we're focusing on, the expense ratios can be incredibly tiny. We're talking often around 0.04% or 0.05%.
0.04%. That's almost nothing.
It's incredibly low. Now, compare that to actively managed U.S. stock funds. The sources we reviewed cited typical average expense ratios around 0.44%, and it's not uncommon to see active funds charging well over 1% per year, sometimes even more for certain strategies.
Wow. Okay, so for every, say, $10,000 you invest, you might pay just $4 or $5 a year in fees for a broad index fund like VTSAX.
Right.
Compared to maybe $44 on average, or potentially $100, even $150 or more for an actively managed fund. That seems small maybe in 1 year, but over decades, that must really add up.
It has a dramatic effect. Because of compounding. High fees mean compounding works against you. Let's use that example from the sources that makes it really clear.
Okay.
Imagine the overall market index returns a solid 10% before any expenses in 1 year. Good year. An index fund tracking that index, maybe it has a tiny 0.1% expense ratio, just to make the math easy. It delivers 9.9% to you, the investor, after expenses.
Makes sense. 10 minus 0.1.
Right. Now let's take an actively managed fund, and let's be generous and say the manager was skillful or lucky, and they also managed to pick stocks that delivered that same 10% return before their expenses. That's already a challenge, as we know.
Yeah, beating the odds there.
But let's say they did it, but their fund has a more typical 1.15% expense ratio. Your return after their expenses is only 8.85%.
Okay, so 9.9% versus 8.85%. That's over a full percentage point difference.
Exactly. A 1.05% difference just from fees in that one hypothetical year. Now, that might not sound like a disaster year to year, but compound that difference over 20, 30, 40 years of investing for retirement.
Oh, wow.
The difference in your final account balance can be absolutely staggering. We're talking potentially tens, maybe even hundreds of thousands of dollars less simply because you were in the higher fee fund. Lower fees mean more of the investment returns actually stay in your pocket, working for you.
That example really hammers it home. Minimizing costs is just.
Yeah.
It's critical for long-term success. Okay, so low cost is number one. What's the second big driver of index fund popularity?
Diversification, definitely.
Don't put all your eggs in one basket rule.
Like the ultimate example of that rule, yeah. And index funds provide instant broad diversification right out of the box. When you buy just a single share of a broad market index fund, like VTSAX,
You own a tiny piece of everything.
you immediately own a tiny piece of hundreds. Or in the case of VTSAX, literally thousands of different underlying stocks. These companies are spread across all sorts of different sectors and industries within that market.
So if one company, or even one whole industry, has a really bad year,
It doesn't destroy your portfolio. This massively reduces what's called idiosyncratic risk or firm-specific risk. That's the danger that a single company you invested heavily in might fail, go bankrupt, or just perform terribly because of its own unique problems, bad management, failed product, whatever.
yeah, if you only own like 2 stocks and one goes to zero, that's devastating.
Exactly. With a broad index fund, the poor performance of any single stock is cushioned, it's offset, by the performance of all the hundreds or thousands of other stocks in the index. This built-in diversification is why index funds are almost universally considered much, much less risky than holding just a handful of individual stocks.
And for most people, I mean, unless you're a professional investor with tons of time and resources, trying to build that kind of diversification yourself by buying individual stocks would be, well, pretty much impossible, right?
Totally impractical. And probably way too expensive with trading costs. Imagine trying to buy shares in 4,000 different U.S. companies, figure out the exact right proportions for each one, and then constantly monitor and rebalance them to match the market weights.
Yeah, no thanks.
An index fund does all that complex work for you automatically behind the scenes, which leads us right into the third major appeal, their simplicity and convenience.
Simple objective, easy to grasp.
Right. The goal is super clear. Track the index. That's it. You don't need to spend hours reading dense financial reports, following obscure companies you've never heard of, or trying to guess which way the economy is going to turn next month.
All that decision-making stress is removed.
It really is. You choose the index or indexes you want exposure to, you invest your money, and then ideally, you just hold on for the long term. This passive, hands-off approach is incredibly appealing, especially for people who want their money working hard for them, but frankly don't want investing to become a second job.
And then there's the track record. I mean, going back to those stats you mentioned right at the start about most professional managers underperforming.
Yeah.
That's just hard to ignore when you're deciding where to put your money.
It is incredibly persuasive data, and it's not just a one-off finding. This pattern has been documented for decades now. The SPVA reports, that stands for S&P indices versus active. Our sources cite them frequently. They consistently show that active managers, as a group, really struggle to beat their benchmarks after you account for their fees.
What were those numbers again?
Over the last 15 years, ending recently, for example, something like 88% of actively managed U.S. large-cap funds investing in big U.S. companies underperform the S&P 500 index. 88%.
Wow, and even over shorter periods.
Still pretty stark. Over a recent 5-year period, it was around 79% underperforming. The numbers fluctuate a bit year to year, but the long-term trend is overwhelmingly clear.
So the data is basically saying that the vast majority of people whose full-time job is to pick stocks, they can't reliably keep up with just owning the index itself, especially after fees. That really makes the case for index funds, doesn't it?
It really does. By simply choosing to match the index return through a low-cost fund, you are statistically likely to achieve a better outcome than you would have gotten by picking the average actively managed fund after you subtract their higher fees. You're essentially locking in a historically superior result by choosing the simple, cheap option.
And sticking with that simple strategy long-term means you have to be willing to ride out the market's inevitable rough patches.
Absolutely essential. You cannot panic sell. The sources remind us of periods like the 2008 global financial crisis. The S&P 500 dropped around 38% from its peak. That hurt.
I remember that. Scary times.
Or, even more recently, that sudden, sharp drop in early 2020 when COVID-19 hit the market fell about 31% very quickly. Watching your account balance plummet like that in real time, it's definitely painful. It tests your resolve.
For sure.
But the historical data also shows, very clearly, that markets have always recovered from these downturns and eventually gone on to reach new highs. That S&P 500 that fell 38% in 2008, by early 2018, it had gained something like 325% from that bottom. Now, obviously, past performance doesn't guarantee future results. We always have to say that.
Right, the standard disclaimer.
But this historical pattern of resilience and long-term growth is the bedrock of the whole buy and hold index investing philosophy. You trust the process, you trust history, and you stay invested.
And because index funds don't trade very often, that also leads to tax advantages, doesn't it? Especially outside of retirement accounts.
Yes, that's another significant benefit, particularly in regular taxable brokerage accounts. Because index funds buy and hold, their turnover, the amount of trading they do, is much lower than active funds. Active funds are constantly buying and selling based on their manager's calls. When a fund sells a stock that has gone up in value, it realizes a capital gain. These realized gains often have to be distributed to all the fund's shareholders at the end of the year,
creating a tax bill for you, even if you didn't sell anything yourself.
Exactly. You get hit with a tax liability just because the manager was trading inside the fund. Index funds, with their low turnover, realize far fewer capital gains from internal trading. This means they tend to make fewer and smaller capital gains distributions, making them generally more tax efficient in a taxable account.
Fewer unexpected tax surprises. Like the sound of that. Okay, let's zoom in now on our star example, VTSAX. Why is this particular fund so often mentioned? Like, why is it the fund people talk about for simple U.S. stock market investing?
Well, VTSAX, that's the Vanguard Total Stock Market Index Fund Admiral shares. It's incredibly popular because it basically perfectly embodies all those advantages we've just discussed. It bundles them all up into a single, widely available, really efficient package.
Okay, and what exactly does VTSAX represent or track?
As the name tells you, And like we touched on earlier, its job is to track the performance of the CRSP US Total Market Index.
Yeah.
And this is really key. It's not just tracking the big guys like the S&P 500 does.
It's broader than that.
Much broader. It includes large cap companies, mid cap, small cap, even tiny micro cap stocks. It aims to cover about 99.5% or more of the total value, the total capitalization of the entire US equity market. So when you own VTSAX, you literally own a tiny slice of almost every publicly traded company in the United States.
Wow, that scale is just immense. Do we know how many companies it actually holds?
Yeah, the sources we looked at noted that as of October 2023, VTSAX held shares in 4,163 different companies.
The 4,000.
Yep. And it's a massive fund in terms of assets, too, over $1.2 trillion under management. Its top holdings, as you'd expect, are the biggest companies in the U.S. market right now. Names you know: Apple, Microsoft, Amazon, maybe Tesla, the alphabet companies, Google.
So the big tech names mostly.
They dominate the top, yeah, simply because they are the largest companies by market value. Those top 10 companies actually make up a pretty significant chunk of the fund, around 25% of the total assets, just reflecting their weight in the overall U.S. market.
And the costs. You said index funds are low cost, but VTSAX is kind of famous for being really low cost, right?
Absolutely. It's one of the standard bearers for low fees. Its expense ratio is just minuscule, 0.04%.
0.04. So that's just $4 in fees per year for every $10,000 you have invested.
Exactly. Almost unbelievably cheap compared to traditional funds. And its turnover ratio is also very low, only about 3.5%, which again reinforces that point about infrequent trading and better potential tax efficiency.
Okay, so this incredibly low cost combined with owning basically the entire U.S. stock market, that's the foundation for this whole VTSAX and chill idea, isn't it?
It really is. VTSAX and chill. It's not some formal strategy from a finance textbook, right?
Right, it sounds more like internet slang.
It kind of is. It's an informal term that really took off, especially within the financial independence or SII community online. It perfectly captures this approach. Invest a big chunk, often the vast majority of your long-term investment money, into a single, super cheap, broadly diversified total stock market index fund like VTSAX.
And then?
You chill. You adhere strictly to a long-term buy-and-hold approach.
So chill means you resist the urge to constantly tinker. Don't check your balance every day. Don't panic sell when the market drops. Don't try to time the next rally.
That's exactly it. It's about having faith in the long-term growth potential of the overall U.S. economy and the stock market. It's about trusting the built-in diversification and the incredibly low costs of the fund. And it's about just letting the magic of compounding do its heavy lifting over decades without you interfering.
So it really aligns perfectly with that passive investing philosophy we talked about earlier, grounded in the idea that trying to constantly outsmart the market is usually a losing game for most people.
Precisely. It accepts the market return, minimizes costs, maximizes diversification within U.S. stocks, and relies on time and patience.
And that compounding power is really the engine driving the potential success of VTSAX and chill, right? Can we use VTSAX itself to show how powerful that can be?
Yeah, the sources gave a great illustration of this. Let's say you had invested $10,000 into VTSAX way back at the start of the year 2000.
Okay, $10K and $2,000. Rough time to start right after the dot-com bubble peak.
Yeah, not the luckiest timing, perhaps.
Wow.
But let's say you invested that $10,000 and you just stuck with it. You held on through the dot-com crash, through the 2008 crisis, through everything else, and crucially, you reinvested all the dividends and any capital gains distributions you received back into the fund.
Okay, buy, hold, and reinvest.
By the end of 2023, that initial $10,000 would have grown to approximately $77,000.
$77,000 from $10,000 despite starting near a peak. That's pretty impressive.
It is. Now, here's the kicker, showing the power of reinvesting. If you had invested the same $10,000 at the same time, but you didn't reinvest those distributions, maybe you just took them out as cash each year.
Okay.
Your ending balance at the end of 2023 would have been significantly lower, only around $55,000.
Wow. So $77K versus $55K, that's a $22,000 difference on just a $10,000 initial investment over 23 years.
Exactly. That $22,000 difference is purely the result of reinvesting your earnings and letting them start earning returns too, the power of compounding in action. It's a really vivid argument for just staying invested, reinvesting everything, and being patient. Let the fund do the work.
That visual is really striking. It absolutely drives home why that chill part, just buying and holding patiently, even through the scary downturns, can be so incredibly effective over the long haul. Okay, so we've established index funds track indexes, but you mentioned indexes aren't static. They change. How do they stay relevant? What happens when companies grow or shrink, or the market evolves?
Right. That's a really important mechanism called index rebalancing. An index isn't just carved in stone forever. It needs regular tune-ups, periodic adjustments to make sure it still accurately reflects the specific slice of the market it's supposed to represent.
So it's like the people who manage the index, the S&P folks or whoever, they have to do regular maintenance on it.
That's a good way to put it. Index rebalancing is the process where the company that maintains the index, like S&P Dow Jones indices for the S&P 500 or CRSP for the total market index VTSAX, follows. They systematically review and adjust two key things. First, the index's composition, which companies are included or excluded. Second, the weighting of the assets within the index, how much influence each company has.
Why is that necessary? Doesn't changing the components kind of go against the idea of just passively tracking a stable benchmark?
It seems counterintuitive, but it's essential precisely because the market itself isn't stable. Companies are dynamic. They grow large enough to qualify for an index they weren't big enough for before. Or they shrink, maybe they get acquired by another company, they merge, sometimes they even go bankrupt and disappear.
Right, the business world is always changing.
Exactly. So if an index didn't rebalance, it would quickly become outdated. It would stop being a true reflection of the market segment it claims to track. For instance, a large cap index like the S&P 500 needs a way to kick out companies that have shrunk and are no longer large cap and add in the companies that have grown into the large cap category.
So rebalancing keeps the index accurate and relevant.
Correct. It ensures the index maintains its intended characteristics, like focusing only on large companies or covering the total market. It also helps maintain a balanced risk profile. Without rebalancing, an index could become overly concentrated in just a few companies that have grown enormous, or hold on to companies that are declining significantly, which could increase risk.
Okay, that makes sense. It's about keeping the index true to its purpose. So how does this rebalancing process actually work? What are the steps?
It's a pretty systematic, rules-based process. First, the index provider S&P, CRSP, FTSE Russell, etc., gathers a ton of market data. They analyze company performance, market capitalization, size, trading volume, and things like that.
Okay, data collection first.
Then they apply a predefined set of objective criteria for inclusion or exclusion from the index. These rules are public and clear. They might be based on achieving a certain market cap rank, having enough liquidity, meaning the stock trades easily without moving the price too much, belonging to the right sector or country, sometimes even meeting profitability requirements, or having a certain amount of its shares available for public trading, the public float.
So you have to meet the specific rules to get in or stay in.
Exactly. Based on which companies meet or fail these criteria at the review date, a committee at the index provider typically reviews the candidates and officially selects the companies to be added and the ones to be removed.
Then they figure out the weights.
Right. After the list of constituents is finalized, they recalculate the weighting. As we discussed, most major stock indexes, including the S&P 500 and the total market index VTSAX tracks, are market capitalization weighted. This just means a company's weight or influence in the index is directly proportional to its total market value. Bigger company, bigger weight. So during rebalancing, these weights are adjusted based on the new list of companies and their current market caps.
And then they announce it.
Yep. The index provider announces the upcoming changes publicly, which stocks are coming in, which are going out. And they set an effective date, typically a week or two later, when the changes officially take place in the index calculation. That gap between announcement and effective date gives everyone time to react.
Everyone, meaning the index funds.
Primarily the index funds and other institutional investors who track the index, yes. They need that time to adjust their own holdings to match the upcoming changes in the index.
Can you give us a concrete example of this rebalancing process and how it affects things?
Sure. A really common one mentioned in the sources is the S&P 500's quarterly rebalancing. It happens like clockwork on the third Friday of March, June, September, and December.
Okay.
The sources pointed to the December 2024 rebalancing as a specific example. In that cycle, companies like Apollo Global Management, Workday, and Lennox International were added to the S&P 500 because they met the size, liquidity, and other criteria. At the same time, companies like Amentum Holdings, Corvo, and Catalent were removed, presumably because they no longer met those criteria. Maybe their market cap fell below the threshold.
And this affects sector weights too.
Subtly, yes. Adding or removing companies naturally shifts the overall balance. For instance, that December 2024 rebalance resulted in slight increases in the total weight of the financials and information technology sectors within the S&P 500 index.
What's the actual impact of all this buying and selling on the stock market itself when rebalancing happens?
It can actually be quite significant, especially in the days leading up to and right on the effective date. Why? Because there are literally trillions of dollars in index funds and other investment products that are mandated to track these major indexes. The sources mention something like $16 trillion tracking just the S&P 500 alone.
$16 trillion.
Yeah. So when the index changes, the managers of all those trillions of dollars have to adjust their portfolios. They must buy the stocks that are being added to the index, and they must sell the stocks that are being removed.
Which creates a huge wave of focused buying or selling pressure on those specific stocks.
Exactly. Stocks being added often see a temporary price bump as all these index funds rush to buy them up before the effective date. Conversely, stocks being removed might experience a temporary price dip as funds are forced to sell them off.
So it causes short-term volatility in those specific stocks.
Yeah, definitely. You often see a surge in trading volume and price movement around the announcement and effective dates. It's a well-known market phenomenon. Some sophisticated traders even try to anticipate these index changes and trade ahead of them, though that's a tricky game. And being added to a really prestigious index like the S&P 500 is often seen as a big vote of confidence for a company. It can increase its visibility to investors and potentially improve its trading liquidity long term.
Okay, so that's the market impact. But how does this index rebalancing affect the everyday person who's just holding an index fund like VTSAX? Do they need to worry about this or do anything?
That's the beauty of index funds for the individual investor. No, you don't have to do anything at all. Your fund manager handles everything automatically inside the fund.
So they do the buying and selling needed to match the new index.
Exactly. They adjust the fund's holdings to align perfectly with the updated index composition and weights. From your perspective as the fund owner, it's completely seamless. Your portfolio just automatically stays in sync with the evolving market definition represented by the index.
What about those capital gains distributions we talked about? Does the selling that happens during index rebalancing trigger those tax bills for investors?
Yes, it can. That's one of the primary ways a passive index fund does generate potential taxable distributions. When the fund manager sells stocks that are being removed from the index, if those stocks have gone up in value since the fund originally bought them, the fund realizes a capital gain.
And those gains have to be paid out.
In taxable accounts, yes. Those realized gains generally must be distributed to the fund's shareholders, typically once a year. This creates a tax liability for you, even though the selling happened inside the fund due to the index changing.
Okay.
However, and this is important because index funds generally have very low turnover. Remember, VTSAX was only 3.5%. The amount of selling required during rebalancing is usually much smaller than the constant trading inside an active fund. So while rebalancing can trigger some capital gains distributions, the amount is typically much lower and less frequent compared to actively managed funds.
So less tax impact overall compared to active funds.
Generally, yes. The sources also point out that while those temporary stock price wiggles caused by rebalancing might happen, for the ordinary long-term index investor, the overall effect on their portfolio value from the rebalancing itself is typically neutral over time. They're just maintaining their slice of the index as it naturally evolves.
Okay, so index funds sound incredibly appealing. We've got the low costs, the amazing diversification, the simplicity, that historical performance edge over most active funds. But what are the downsides? The potential drawbacks or risks? Nothing in investing is perfect.
That's absolutely true, and it's crucial to understand the limitations. Index funds are not some kind of magic bullet that guarantees success without risk. One of the most significant risks, and it's inherent in the strategy, is market volatility.
Meaning, simply when the whole market goes down, your index fund is going down right along with it. No escape.
Precisely. Index funds are designed to give you full exposure to the market's movements, both up and down. They don't employ defensive strategies like trying to time the market by moving into cash or shifting into less volatile assets when things look dicey. Their job is to track the index, period.
So if the index drops 30%, your fund drops roughly 30%.
Yep. So during those big market downturns we talked about, 2008, 2020, your index fund will experience losses that mirror the market's decline. There's no built-in downside protection or floor to limit your losses in a crash. And this can be really challenging psychologically, but also practically if you happen to need access to your invested money during one of those significant market dips. You could be forced to sell your shares at a substantial loss.
You get the market's full upside potential, but you also accept its full downside risk.
Exactly. Another potential drawback, especially if you only invest in a single fund like VTSAX, is actually a lack of complete diversification.
Wait, didn't we just say diversification was a huge benefit?
Yes, diversification within its asset class. VTSAX is incredibly diversified within the U.S. stock market. But by design, it focuses only on U.S. stocks.
Okay, so it ignores everything happening outside the U.S.
Correct. It doesn't give you any exposure to international stocks companies in Europe, Japan, China, emerging markets. It also doesn't include other major asset classes like bonds, real estate investment trusts, REITs, commodities like oil or gold, or other alternative investments.
And why is diversifying beyond just U.S. stocks generally considered a good idea for a portfolio?
Because these other asset classes offer different risk and return characteristics. Their performance may not always move in perfect lockstep with the U.S. stock market. Sometimes international markets might be outperforming the U.S. or vice versa. Adding international stocks gives you diversification across different economies, different currencies, different political environments.
Okay, spreads the risk geographically. What about bonds?
Bonds are key for managing overall portfolio volatility. While they generally have lower long-term growth potential compared to stocks, high-quality bonds tend to be much less volatile. They can provide stability and act as a cushion during stock market downturns, potentially reducing the severity of your portfolio's losses.
So they smooth out the ride a bit.
Exactly. That's why many standard investment frameworks suggest that a truly globally diversified portfolio shouldn't just hold U.S. stocks. It should also include a significant allocation to international stocks, maybe through a fund like Vanguard's VXUS, which tracks non-U.S. markets, and potentially bonds, depending on your age, goals, and how much risk you're comfortable taking.
Okay, so VTSAX is fantastic for getting broad U.S. stock exposure easily and cheaply, but it might not be a complete diversified portfolio all by itself for everyone.
That's the standard view when thinking about constructing a robust long-term portfolio, yes.
What other drawbacks are mentioned?
Well, another point, often raised by proponents of active management, is simple. By definition, an index fund cannot beat its benchmark index. Its whole goal is just to match it, minus those tiny fees.
Right, you're guaranteed to get pretty much the average market return, not better.
Correct. So while index funds consistently beat most active managers after fees are factored in, they will never be that superstar fund that doubles your money in a single year, because the manager made a few incredibly brilliant, concentrated stock picks that paid off massively.
You give up the chance for that huge outperformance.
You do. Index investing means consciously foregoing that possibility of capturing alpha, those returns above the benchmark, generated by skill in favor of reliably and cheaply capturing beta, which is just the market's return itself.
Okay. And what about that market cap weighting thing we discussed earlier?
Yeah.
Where the biggest companies have the biggest influence. Could that be seen as a drawback too?
It can be, yes, because market cap weighted indexes, like the total market index VTSAX follows, automatically allocate more money to the companies that are already the largest. This means the fund's performance can become quite heavily influenced by just the top few mega cap stocks.
So if the, say, top 5 or 10 companies in the U.S. market hit a rough patch or stagnate, it can really drag down the performance of the entire index fund significantly.
Precisely. Your fund's returns become heavily tied to the fate of these giants. It means the fund is essentially forced to invest more in companies simply because they have already grown enormous. Some argue this could mean you're systematically over-allocating to potentially overvalued companies, or companies whose fastest growth phase might already be behind them just because of their size, not based on a fundamental analysis suggesting they're a good value or have the best future prospects.
Interesting point. You're buying more of what's already popular and big.
In a sense, yes. We also mentioned index rebalancing causing those temporary stock price swings. Is that considered a risk for investors?
Well, should people worry about that?
For the vast majority of long-term buy-and-hold index investors, those temporary price fluctuations around the rebalancing dates are mostly just noise. Your fund is simply adjusting its holdings to match the new index weights as designed. The impact on your overall portfolio value due to that specific phenomenon is usually pretty neutral over time. The main practical impact from rebalancing for the individual investor is really just the potential for those small capital gains distributions we talked about earlier.
Okay, so more of a minor tax consideration than a major risk.
Got it.
All right, let's shift from the theory and the pros and cons to the practical side. If someone listening is thinking, okay, this index fund approach sounds pretty sensible for me, how do they actually get started? How do you invest in something like VTSAX?
The good news is it's generally a very accessible and straightforward process these days. The first step is really choosing an investment platform or brokerage account provider.
Like Vanguard itself or Fidelity, Schwab?
Exactly. Those are the big traditional ones. Or you might look at some of the newer online platforms like M1 Finance or others. When choosing, you'll want to consider a few things. Does the platform offer the specific index funds you're interested in? What are the fees, if any, for treating those funds or maintaining the account? How's their customer support? Are their website and tools easy to use? Do they offer the research you might want?
Okay, pick your platform. Step 2.
Step 2 is opening an account. This usually involves providing your personal information, maybe answering some questions about your investment goals, like are you saving for retirement decades away, or a house down payment in 5 years. They'll also ask about your risk tolerance. How comfortable are you with potential ups and downs?
And you choose the type of account.
Right. You need to decide if you want a regular taxable brokerage account or if you want to use a tax-advantaged retirement account. Common retirement options are traditional or Roth IRAs, which you open yourself, or maybe a 401k or similar plan offered through your employer, which often have their own menu of investment options, hopefully including good index funds.
Then you put money in it.
Yep, you fund the account. Usually this is done by linking your bank account and making an electronic transfer, ACH, or maybe wiring funds.
Okay, account open, money's in. What's next? Selecting the actual fund or funds?
Exactly. This is where you make your investment choice. Based on everything we've discussed, your goals, your risk tolerance, your desire for diversification, you decide which index or indexes you want to track.
Maybe just VTSAX or VTI for total U.S. market.
Right.
Or maybe add something else.
Right. You might decide VTSAX or VTI covers your U.S. stock allocation perfectly. Or you might decide, okay, I want U.S. stocks, but I also want international stocks for better global diversification and maybe some bonds for stability. In that case, you'd select multiple index funds, maybe a total U.S. stock fund, a total international stock fund, and a total bond market fund, and decide how much of your money goes into each.
How do you compare funds?
You'll look closely at their expense ratios. Lower is better, all else being equal. You'll confirm exactly which index they track to make sure it aligns with what you want. You might glance at their historical performance, but always remember that past returns are no guarantee of future results. The index tracked and the cost are usually the most important factors.
Makes sense. And then finally, you just buy it.
Yep. You place a buy order through your brokerage platform. You tell them how much money you want to invest in a specific fund, or maybe how many shares you want to buy, especially for ETFs. Most platforms make this really simple, just a few clicks.
And then you chill.
Pretty much. The final step is just periodic monitoring. And this doesn't mean checking your account balance obsessively every day. It means maybe once a quarter or once a year, you take a look at your overall portfolio. You check if your asset allocation, the mix between stocks, bonds, international, etc., still makes sense for your goals and timeline. If it's drifted significantly because one part grew much faster than another, you might need to rebalance your portfolio back to your target percentages. But that's very different from the index rebalancing we talked about earlier. This is about maintaining your chosen strategy.
Got it. Okay, now let's tackle that specific point of confusion we teased a couple of times.
Yeah.
VTSAX versus VTI. This comes up constantly. They both track the exact same index, that CRSP U.S. Total Market Index. They both have the exact same super low 0.04% expense ratio from Vanguard.
Yeah.
So what is the difference, and does it actually matter which one someone chooses?
Yeah, this trips a lot of people up, understandably, because they seem identical on the surface, but once you grasp the core difference in their structure and how they trade, it becomes much clearer.
Okay, lay it out for us.
The fundamental difference is this. VTSAX is a traditional mutual fund. VTI is an exchange-traded fund, or ETF.
Mutual fund versus ETF.
Right. They are essentially just two different wrappers, two different legal structures, built around the exact same underlying basket of roughly 4,000 U.S. stocks. Think of it like having the same juice sold in either a carton mutual fund or a bottle ETF.
Yeah.
The juice inside is identical.
Same contents, different package. I like that.
Yeah.
So how does the package differ in practice? Let's start with VTSAX, the mutual fund.
Okay. With VTSAX, the mutual fund, when you want to buy or sell shares, you transact directly with the fund company, which is Vanguard in this case. Your order, along with everyone else's orders for that day, gets processed only once per day after the stock market closes at a price called the net asset value, or NAV. The NAV is just the total value of all the fund's underlying stocks at the end of the trading day, divided by the number of fund shares outstanding.
So you don't know the exact price when you place your order during the day.
Correct. You just place your order to buy, say, $1,000 worth, and you get whatever number of shares that $1,000 buys at that evening's closing NAV price. Another key practical point for VTSAX, specifically the Admiral shares class, which has the lowest expense ratio, is that if you invest directly with Vanguard, there's historically been a $3,000 minimum initial investment required to get started.
$3,000 minimum.
Yeah.
Okay. Any advantages to the mutual fund structure?
One big logistical advantage, especially if you're investing directly at Vanguard, is how incredibly easy it is to set up automatic recurring investments. You can just tell Vanguard, take $200 out of my bank account every 2 weeks and put it straight into VTSAX. It's very set it and forget it friendly for dollar cost averaging.
Okay, that's VTSAX, the mutual fund. Now, VTI, the ETF, how is that different?
VTI, being an ETF, behaves much more like an individual stock. It trades on stock exchanges like the NYSE Arca throughout the entire trading day. When you buy or sell shares of VTI, you're typically trading with another investor on the open market through your brokerage account, not directly with Vanguard in the same way as the mutual fund.
So the price fluctuates all day long.
Yes, the price of VTI shares will fluctuate throughout the day based on supply and demand, though it generally stays very, very close to the real-time value of its underlying stocks, the intraday NAV, thanks to market mechanisms. A big plus for VTI is that there's typically no minimum initial investment imposed by Vanguard beyond the price of a single share. So you could start with, say, $200 or whatever one share costs.
No minimum trades all day. Any other differences?
ETFs like VTI also offer more trading flexibility, if that's important to you. You can use more advanced order types like limit orders, where you specify the exact price you're willing to buy or sell at, or stop-loss orders. And some people find ETFs can be slightly easier or more precise for certain advanced strategies like tax loss harvesting, where you need to identify and sell specific share lots you bought at a higher price.
Okay, so the mechanics of how you buy and sell, the minimums, and the trading flexibility are the main practical differences. Now, what about that crucial tax efficiency angle we discussed? You mentioned earlier that ETFs are generally considered more tax efficient than mutual funds and taxable accounts.
Yeah.
How does that play out specifically with VTSAX versus VTI? This seems key.
This is the crucial nuance, and it's where Vanguard does something special. You're right. The general rule is that traditional mutual funds can be less tax efficient in taxable accounts. Why? Because when investors sell their shares back to the mutual fund company, redeem them, the fund manager might be forced to sell some of the fund's underlying stocks to raise cash to pay out those departing investors. If those stocks being sold have gone up in value, the fund realizes capital gains. And under mutual fund rules, those realized capital gains typically have to be distributed proportionally to all the remaining shareholders at the end of the year.
So you could get hit with a capital gains tax bill just because other people were selling their shares of the mutual fund.
Exactly. Even if you held onto your shares all year. ETFs generally avoid this problem because of how they are structured. They use a unique creation and redemption mechanism involving large institutional investors called authorized participants. These institutions can exchange large blocks of the underlying stocks directly for blocks of ETF shares and vice versa. This process usually allows the ETF to avoid selling appreciated stocks just to meet redemption requests from individual investors trading on the exchange.
So ETFs usually sidestep passing on those capital gains from shareholder selling activity.
Correct. However, and this is the big but for Vanguard, Vanguard actually holds a patent on a unique fund structure. For many of their most popular index funds, including VTSAX, the mutual fund shares are legally just a different share class of the very same underlying investment portfolio as the corresponding ETF shares, like VTI.
So VTSAX and VTI are literally drawing from the exact same pool of assets internally at Vanguard.
Essentially, yes. And because of this patented structure, the VTSAX mutual fund share class is actually able to utilize the same tax-efficient creation-redemption mechanism that's typically exclusive to ETFs.
Oh, okay. So what does that mean for the investor?
It means that, specifically for investors holding VTSX at Vanguard, the traditional tax disadvantage of mutual funds largely disappears. VTSAX, despite being a mutual fund, typically does not distribute capital gains triggered by other shareholders redeeming their shares, just like the VTI ETF doesn't. Any capital gains distributions you might see from VTSAX are generally only triggered by that minimal selling required during index rebalancing, or perhaps if the fund itself were shrinking dramatically in size, which is definitely not the case for VTSAX.
That is fascinating. So because of Vanguard's unique structure, the tax efficiency of VTSS and VTI, when held in a taxable account at Vanguard, is effectively the same. The difference is negligible.
For all practical purposes, yes. That common argument that ETFs are always more tax efficient than mutual funds doesn't really hold true when comparing VTSX and VTI at Vanguard because of this specific patented structure.
Okay, that clears up a massive point of confusion. So if the performance is identical, the costs are identical, and the tax efficiency at Vanguard is practically identical. How do you choose between VTSAX and VTI if you're investing directly with Vanguard?
At Vanguard, it really just boils down to those practical conveniences and preferences we talked about.
Like the minimum investment.
Right. Do you have the $3,000 minimum needed to start with VTSAX Admiral shares? If not, VTI lets you start with the price of one share.
And the automatic investing.
Exactly. Do you value the super simple set it and forget it automatic investing directly from your bank account that VTSAX, the mutual fund, offers so easily at Vanguard? Or do you prefer the flexibility of buying single shares of VTI whenever you want during the day?
Maybe you want to use limit orders, or you're using a different platform for auto investing.
Precisely. Maybe you prefer the intraday trading flexibility of VTI. Or perhaps you use a brokerage platform other than Vanguard, like M1 Finance, that allows for automatic investing and buying fractional shares of ETFs, like VTI. In that case, VTI would be the natural choice there.
Okay. And what if you're not investing directly with Vanguard? Say you have your account at Fidelity or Schwab or somewhere else. Does that change the VTSAX versus VTI decision?
Yes, that definitely changes the calculation. If you want to buy VTSAX, which is a Vanguard-specific mutual fund, at a brokerage other than Vanguard, like Fidelity or Schwab, that brokerage will likely charge you a transaction fee to buy it because it's not one of their own funds. They might also impose higher minimum investment amounts.
So it could cost you extra just to buy VTSAX elsewhere.
It likely will. In that scenario, buying VTI, the ETF version, makes much more sense. ETFs like VTI generally trade commission-free at most major brokerages now. Or, alternatively, you could just use that brokerage's own equivalent total U.S. market index fund. Fidelity has FSKX mutual fund and FZROX zero fee mutual fund, or ITOT ETF. Schwab has SWTSX mutual fund, or SCHB ETF. These will likely be cheaper and easier to buy at their respective brokerages.
And potentially more tax efficient than VTSAX at another brokerage.
Potentially, yes, because those other brokerages' mutual funds won't have Vanguard's special patented structure linking them to an ETF share class. So VTI, or the competing ETF from that other brokerage, would likely be the more tax-efficient choice compared to buying the VTSAX mutual fund outside of Vanguard.
Okay, so the choice between VTSAX and VTI really hinges on, are you investing at Vanguard? Do you meet the minimum? Do you prefer mutual fund auto-invest features or ETF trading flexibility? If you're not at Vanguard, VTI, or a competitor's equivalent, is usually the better bet.
That sums it up perfectly. VTI is kind of the universally accessible version that works the same everywhere, while VTSAX has that unique tax parity at Vanguard, but might have drawbacks elsewhere.
Even though index funds are designed to be simple, is there still a place for getting professional financial advice when using them?
Oh, absolutely. While the concept of buying and holding a broad index fund is simple, building a complete, coherent financial plan involves a lot more than just picking one fund.
Like figuring out the overall strategy.
Exactly. A good financial advisor can help you with really crucial things like determining the right overall asset allocation for your specific situation, considering your age, your goals, your time horizon, your tolerance for risk. How much should you actually have in stocks versus bonds? How much should be U.S. versus international?
Stuff that goes beyond just VTSAX.
Right. They can help you construct a truly diversified portfolio using multiple low-cost index funds to achieve that target allocation. They can also be invaluable for tax planning, especially if you have investments in taxable accounts alongside retirement accounts, or if you have complex income situations or estate planning needs.
Managing withdrawals in retirement too, I imagine.
Definitely. Coordinating investments across different account types, managing required minimum distributions, RMDs, tax efficiently, planning for sequence of return risk. These are areas where advice helps. And honestly, one of the biggest values an advisor can provide is behavioral coaching.
Keeping you from panicking during those market downturns.
Exactly. Helping you stick to your long-term plan when your emotions are screaming at you to sell everything. So yes, index funds are a fantastic, simple tool, but a good advisor can help you build the overall blueprint and use that tool effectively as part of your broader financial life.
It's pretty amazing when you step back and think about how index investing went from this obscure, almost ridiculed idea,
Bogle's folly.
right, to
Yeah.
becoming such a dominant force in the investment world today. It wasn't always this mainstream, was it? Where did it even come from?
Not at all. It had a fascinating evolution. The core idea that just tracking an index might be better than active management actually started bubbling up in the academic world way back in the 1960s. You had researchers like Edward Renshaw and Paul Feldstein publishing theoretical papers suggesting how hard it was for managed portfolios to consistently beat diversified benchmarks.
So it began as, like, a theory on paper in universities.
Primarily, yes. The first real-world attempts to create funds that actually mimicked an index started appearing in the very early 1970s, but they were mostly small, limited, or aimed at big institutional clients, not average investors.
Like pension funds.
Exactly. There was something called the Qualidex Fund in 1972 trying to track the Dow Jones, which was flawed, and then Wells Fargo and American National Bank launched index funds for institutional pension clients in 1973.
But still not something you or I could easily buy.
No. A really key moment for bringing the concept out of academia and into the broader public discussion was the publication of Burton Malkiel's now classic book, A Random Walk Down Wall Street, in 1973.
I've heard of that book. Very influential.
Hugely influential. Malkiel brilliantly synthesized all the academic evidence showing that most professional fund managers were failing to beat simple market benchmarks, especially after costs. And he didn't just present the problem, he explicitly proposed a solution. He argued that the investing public desperately needed access to a low-cost, publicly available index fund, basically, a way to just buy the averages easily and cheaply.
And then along came the person most synonymous with making that happen.
Yes, the legendary John Bogle, the founder of Vanguard. Bogle was already deeply convinced from his own industry experience that high costs and the often futile pursuit of active management were seriously harming investors' long-term returns. Inspired by the academic research and Malkiel's powerful arguments, he decided to act.
He launched the first publicly available index fund.
He did. Vanguard launched the first index investment trust on the very last day of 1975, December 31st.
Which is now the giant Vanguard 500 index fund, tracking the S&P 500. I've heard the launch wasn't exactly, well, a roaring success initially.
Roaring success. Far, far from it. It was widely mocked and ridiculed by the established mutual fund industry at the time, competitors, the financial press. They dismissed it as boring, simplistic, even un-American for not trying to beat the market. They famously nicknamed it Bogle's folly.
Bogle's folly. Wow, did it almost fail?
It came pretty close. The initial public offering was a huge disappointment. They were hoping to raise $150 million. They ended up launching with a mere $11 million in assets. It barely scraped by in the early years. But Bogle had this unwavering, almost evangelical conviction in the mathematical logic of low costs and the long-term power of simply owning the market. He stuck with it.
And eventually, history proved him spectacularly right.
Absolutely. Slowly but surely, as the performance data kept rolling in year after year, consistently showing that Bogle's cheap, boring index fund was outperforming the vast majority of its more expensive, actively managed competitors. Investors started to pay attention. The fund began to grow.
When did it really take off?
It was a gradual snowball effect through the 80s and 90s. A major milestone was in 1999 when the Vanguard 500 Index Fund actually surpassed Fidelity's legendary Magellan Fund, then the icon of active management, to become the largest mutual fund in the world by asset size. Bogle's initial folly had undeniably triggered a financial revolution.
That's an incredible story. Really a testament to the power of a simple, data-driven idea, executed with conviction against conventional wisdom. And just look where we are now. You mentioned earlier, passive index funds now account for something like half of all U.S. fund assets.
Roughly half, yes, maybe even slightly more, depending on how you measure it. It's gone from this tiny, ridiculed academic concept to become the absolute cornerstone of investing for millions and millions of people worldwide. A truly remarkable evolution in finance.
Okay, we have covered a ton of ground in this deep dive. We defined index funds. We explored all those powerful reasons behind their massive popularity, especially the low costs and diversification.
The historical performance data, the simplicity.
Right. We used VTSAX as our prime example, representing the entire U.S. stock market. We dug into the mechanics of how indexes stay relevant through rebalancing.
We looked at the potential risks too, the market volatility, the lack of non-US diversification in a fund like VTSAX alone.
We clarified that whole VTSAX versus VTI distinction, especially the Vanguard patent tax efficiency angle, and how the choice depends on where you invest in your preferences.
And we even touched on the fascinating history, from Bobel's folly to market dominance.
So boiling it down, what are the absolute key takeaways for listeners?
I think the first is clarity. Index funds give you a simple, incredibly cost-effective way to get broad diversification and basically capture the returns of whatever market segment they track.
And the evidence is pretty overwhelming. Historically, this passive approach, mainly because of those low costs, has consistently outperformed the vast majority of professional active managers over the long haul.
VTSAX is that prime example for the total U.S. stock market. Huge diversification across U.S. companies, exceptionally low fees. And that VTSAX and chill idea. It really embodies the patient, long-term buy-and-hold mindset that lets compounding work and benefits from the market's historical tendency to recover and grow over time.
But crucial caveat, simple, isn't the same as risk-free. Index funds give you the market's full volatility. They go down when the market goes down. And a fund like VTSAX, while diversified within the US, doesn't give you global diversification. You might need to add international funds, maybe bonds, to build a portfolio that truly matches your overall risk tolerance and goals.
And remember that VTSAX versus VTI choice at Vanguard mostly comes down to practical things like the $3K minimum or your preference for automatic investing versus ETF trading. Their tax efficiency is basically a wash there due to Vanguard's structure. But if you're investing elsewhere, VTI or that broker's own index fund is usually the more practical and cost-effective option.
Okay, so here's a final thought to leave you with, something to mull over. Considering all this data, the fact that most highly paid financial experts with all their resources and sophisticated strategies can't reliably beat a simple, cheap index fund after you account for their fees, what does that really tell you about where the true advantage might lie in investing for most people?
Yeah, is the edge really found in trying to be smarter, faster, or luckier than everyone else? Or is it maybe found in something much less glamorous but perhaps more powerful? Having the discipline, the patience, and the low-cost structure to simply capture the market's return year after year, decade after decade.
Think about that compounding effect again. That sickeningly tiny difference in annual fees, maybe 1%, turning into potentially hundreds of thousands of dollars over an investing lifetime. Does that shift your perspective on what's really most important when it comes to building long-term wealth?
Something to definitely ponder for your own investment journey.
This has been a deep dive into U.S. stock market index funds, using VTSAX as our guide.
Join us next time as we pull together another stack of sources and dive deep into a whole new topic.